Recorded on August 5, 2025, this deep dive is your essential shortcut to understanding the financial headlines shaping our world right now.
And there's a lot shaping it, that's for sure.
Absolutely. Today, we're cutting through the noise, really getting you well-informed on some truly surprising company earnings jumps.
Like Lemonade.
Right.
Huge splash.
Exactly. An insurance provider, LMND, making a massive splash. And then there's a manufacturing marketplace, Xometry, building some really strong results.
And then we zoom out.
Yeah, to the big picture,
Yeah.
the U.S. trade deficit, it's plunged to a near two-year low. We'll explore how this connects directly to the, well, dizzying world of new tariffs.
High stakes is putting it mildly. We'll also unpack that looming tariff deadline and the international scramble it's causing.
Right. Including that just staggering 250% threat on pharmaceuticals. We'll get into that.
So get ready for clear insights, actionable takeaways.
All custom tailored for you. Let's dive in.
Okay, let's start with a company that's really defied expectations today, Lemonade.
Lemonade. Yeah, the AI-powered insurance provider. Just an absolutely stunning Q2 performance. Their stock jumped, what was it, 29% today?
29%, incredible.
Most people don't think insurance and sweet returns in the same sentence. So what's their secret sauce? Those numbers are certainly refreshing.
Refreshing indeed. Well, digging into their Q2 financials for this year, Lemonade reported revenue of $164.1 million. That's up a robust 34.5% year-on-year.
Wow.
And it actually beat analyst estimates by about 2.4%. Now, their GAAP loss per share, that's their loss based on standard accounting principles, came in at negative 60 cents.
Which just sounds bad, but
But it was significantly better than the negative 80 cents analysts expected. So a nearly 25% beat there.
okay, so better than expected losses.
Exactly. But what really stands out is their gross profit. It more than doubled up a massive 109% year-on-year to $64.3 million.
109%.
Yep. And their gross margin improved by 14 percentage points, hitting 39%. I mean, these point to some serious improvements in how efficiently they're running the business.
Wow, those are genuinely impressive figures, especially that jump in gross profit. That signals a real, turnaround in their core business, doesn't
It
it?
really does. A core metric for insurance companies is net premiums earned. For Lemonade, that was $112.5 million, about 69% of their total revenue. This reflects their actual insurance business performance, which is usually more predictable than, say, investment returns.
Right, the bread and butter.
Precisely. Now, it was a slight miss on analyst estimates for that specific metric, but the overall revenue beat grabbed the headlines because it showed their fundamental business is really gaining momentum.
Okay.
And they also raised their full-year revenue guidance, now expecting between $710 and $715 million. That signals some strong confidence.
So their AI platform, that whole digital approach, giving back unused premiums, it's actually working, driving demand.
It appears so. Healthy demand seems to be the key phrase they're using.
So Lemonade isn't just a quirky startup anymore. They're showing that tech can seriously shake up even a, kind of staid industry like insurance. It's a genuinely positive surprise. Shows resilience in unexpected places.
Absolutely. And speaking of strong performances, let's pivot to another company making waves. Xometry Inc., ticker XMTR.
Xometry.
Also seeing a huge stock jump today with its Q2 earnings up a whopping 38.49%.
38%. Wow. Xometry really manufactured some strong profits this quarter, didn't they? It's like they're building resilience right into their business model, piece by piece.
Indeed. So Xometry reported a loss per share of $80.52 for Q2. However, their adjusted earnings came in at positive $0.09 per share.
Adjusted earnings.
Right.
That strips out some of the one-off stuff.
Exactly. Things like stock options, debt costs. It gives you, the listener, a clearer view of core profitability. And at 9 cents beat analyst estimates of just 5 cents.
That's how it beat there.
Plus, their revenue also topped forecasts, hitting $162.5 million.
That is a solid beat across the board. Remind us, what exactly does Xometry do, and why is that relevant now?
Certainly. Xometry runs a marketplace for on-demand manufacturing. Think of it like a digital hub connecting businesses needing custom parts with manufacturers who can make them quickly.
Okay. Like an Uber for factories almost.
Sort of, yeah. It's a critical niche, especially now with everyone focused on making supply chains more agile, maybe more localized.
Makes sense.
And looking ahead, they've forecast Q3 revenue between $167 million and $169 million. So these results definitely exceeded Wall Street's expectations. It showcases a surprising degree of resilience within manufacturing, which is a key takeaway, really, given the current climate.
Yeah.
Companies need flexible production.
It's fascinating how these specific niches are not just surviving, but actually thriving, even with all the broader economic challenges. Really highlights how innovation or a smart business model can find success, even with major headwinds.
That's right. And Xometry's success brings up that broad question. How do these individual company stories fit into the constantly shifting global economy?
And on that front, big news.
Truly significant news about the U.S. trade deficit. It narrowed by 16.0% in June, hitting $60.2 billion.
16%.
Yes, that's its lowest point in nearly 2 years since September 2023 specifically.
Wow, okay. Looks like the trade deficit just went on a serious diet, shed some significant weight. What's driving that?
Yeah.
Especially after it was expanding.
It's a really striking shift. It looks like it's a mix of things. Exports were $277.3 billion, down just a bit from May.
Right.
But imports saw a much bigger drop, down to $337.5 billion from over $350 billion.
Imports falling faster than exports. Got it.
And a major contributor here was the trade gap with China. It plunged by nearly a third, down to $9.5 billion.
$9.5 billion. That sounds tiny, relatively speaking.
It's the narrowest it's been since February 2004. And over the last 5 months straight, it's dropped by 70%, or about $22 billion. Imports from China are the lowest since 2009.
That's a massive shift with China. How does that connect to the broader U.S. economy and, all this tariff talk?
Well, this narrowing trade deficit actually helped boost the Q2 U.S. GDP rebound quite a bit. The economy grew at a 3.0% annualized rate.
Right, reversing that Q1 dip.
Yeah, exactly. And remember, that Q1 contraction, the -0.5%, was partly because businesses and consumers bought stuff early to get ahead of expected tariffs.
Front-loading.
Right. So Q2's rebound isn't just pure growth. It's partly the economy kind of finding its footing after that initial tariff anticipation. Now, on the tariffs themselves, the overall average U.S. tariff rate is now estimated at 18.3%.
18.3. That sounds high.
It's the highest since 1934, way up from just 2-3% before Trump returned to office.
Wow, since the 1930s.
Yeah. And there are ongoing U.S.-China trade talks in Sweden right now. Negotiators apparently recommended extending the August 12th deadline to stop tariffs snapping back to over 100%. Trump says they're very close to a deal.
So it really feels like these tariffs are this huge lever being pulled, causing immediate shocks, but also these longer-term shifts, but highest since 1934. What's the broader implication there? That's just remarkable context.
It is. And this looming August 7th deadline for Trump's tiered reciprocal tariffs ranging from 10% to 50% isn't just a date. It's triggering a frantic international scramble.
Yeah, you said Canada's 35% tariff already kicked in August 1st.
That's right. Now everyone else is trying to avoid getting hit. Nations are, scrambling to negotiate exemptions or find workarounds. It really feels like a high-stakes global game of tariff chess right now. Everyone trying not to be the one left holding the bill.
Tariff chess. I like that. Okay, so who's scrambling?
Well, take Switzerland. They're facing a steep 39% tariff. Their president, Corinne Keller-Sutter, is actually in Washington today, August 5th, trying for last-minute concessions.
39%. Ouch.
Yeah. Trump's been skeptical, saying they essentially pay no tariffs. Swiss manufacturers are warning tens of thousands of jobs are at risk. What's interesting is their huge gold exports kind of distort their trade balance on paper.
Right. Makes the deficit look bigger than it is for manufactured goods.
Exactly. But this tariff could hit luxury items hard. Think Rolex watches. A $10,000 watch could jump to nearly $14,000.
Yikes. That's a serious price hike for consumers. What about India? Are they making any progress?
Doesn't look like it. India's chances seem to be dwindling. Their top aides are reportedly heading to Moscow this week, not Washington.
Moscow. Okay, that's in the message.
It does. Trump's threatened to substantially raise tariffs on India beyond the current 25% because of their Russian oil purchases. India's response: they'll protect their interests, and called out double standards. It really shows geopolitics clashing hard with trade policy.
Complex stuff. And the EU, Japan, did they get deals sorted?
The EU struck a 15% deal, but there are still open questions, like exemptions for wine and spirits. They did pause their own U.S. tariff countermeasures for 6 months.
Okay, a partial truce maybe.
Sort of. But what's interesting is the U.S. and EU summaries of their deal differ, especially on investment pledges. The U.S. said $600 billion firm commitment. The EU said they intend to procure or expressed interest.
Subtle but important difference in wording.
Very. As for Japan, their top trade negotiator is in D.C. this week, trying to make sure auto tariffs get cut to 15%. This is even after Mazda already forecast nearly $1 billion profit hit from U.S. tariff.
$1 billion just from Mazda.
Yeah. Overall, global stocks fell last Friday because of all this tariff uncertainty. One expert basically said, in this new system, everybody's a loser.
It really sounds like finalizing these trade deals is harder than planning a last-minute round-the-world trip. The tension is just palpable. Really underscores how interconnected and maybe fragile the global economy is.
It certainly is. And now, let's shift to another headline grabber from President Trump. Potential tariffs on semiconductor and pharmaceutical imports, possibly within the next week or so.
Whoa, okay. And wasn't there a really huge number attached to that? Did he really say 250%? Is that even possible? Or is it more of a shock tactic? The scale is just mind-boggling.
It's definitely an aggressive stance. For pharmaceuticals, Trump's specific threat is small tariffs initially, then escalating to 150% in a year and a half, and then potentially 250%.
250%.
And the stated goal is explicit. We want pharmaceuticals made in our country. He did say semiconductor tariffs would be in a different category.
Okay. And how does this land with pharma companies? Some just reported earnings, right?
Right. Pfizer actually beat Q2 estimates and reaffirmed their 2025 outlook. Regeneron also saw a beat, driven by Dupixent sales. But on the other hand, Moderna lowered its 2025 sales forecast and announced cost cuts, layoffs. So it's a mixed picture even before these potential tariffs hit.
And what about those Swiss pharma companies? You mentioned their president was in town.
Yes, Swiss pharmaceuticals are a key export. They could face separate levies despite big players like Roche and Novartis pledging $70 billion in U.S. investments. It suggests even voluntary investment might not be enough protection.
So even companies doing well or investing heavily might feel the squeeze. What's the EU saying about this specific pharma threat?
The EU is reiterating their position. Their goods, cars, and parts included face that flat 15% tariff from their deal and won't go higher even if the U.S. raises tariffs on chips and medicines, though they still expect, quote, turbulence.
Turbulence sounds like an understatement.
Possibly. Now, on a related but somewhat concerning note, there's this controversy around government economic data. Trump recently fired the Bureau of Labor Statistics commissioner.
Fired the BLS commissioner? Why?
Claims of rigged numbers and a sort of vague desire expressed by Trump to shape how government data is presented. This has definitely worried economic observers about data reliability. One expert, Jay Pulaski, said he's 100% wary now.
Worrying about the data itself? That adds another layer of uncertainty, doesn't it?
It does, though for what it's worth, Trump posted positively on Truth Social about Tuesday's stock market gains.
Right. Still, the potential ripple effects from these incredibly high tariffs for companies, for consumers, it could be enormous. Makes you wonder how adaptable supply chains really can be and what this means for the cost of, well, everything for everyday people.
Okay, let's switch gears. It's time for our rapid-fire listener questions. We've plucked 3 burning questions from the inbox that really get to the heart of what we've been discussing. First up,
Let's do it.
given the new tariff landscape and President Trump's recent comments about the Bureau of Labor Statistics, can we still trust the U.S. government's economic data? Or do we need a new financial truth serum?
A truth serum would be nice. Look, it's a crucial question, and many experts are grappling with it. As mentioned, Jay Pulaski said he's 100% wary, so investors definitely have reason to be cautious. What we're seeing is this kind of tug of war.
Between the economic drag from tariffs on one side and the resilience of U.S. companies, often boosted by things like AI spending on the other. Some strategists lean towards resilience winning out, but the key takeaway for you, the listener, is critical thinking.
Don't just take the headlines at face value.
Exactly. Don't rely on one number or one source. Look at a range of indicators, especially from diverse independent sources, to form your own informed opinion.
Great advice. Okay, question 2. With these new tariffs, especially the potential 250% on pharmaceuticals, how might this impact everyday consumers and supply chains beyond what big companies like Caterpillar and Mazda are reporting?
Right, we hear about the multi-billion-dollar hits for Caterpillar and Mazda, but the impact definitely ripples much further. Those big hits signal that price increases for consumers or deeper profit cuts for companies are highly likely.
Someone has to pay.
Someone does. Now, large companies have some ability to offset costs, like Mazda changing shipping routes, maybe boosting U.S. output. But you, the consumer, will likely bear some burden through higher prices. On imported goods, maybe luxury items like those Swiss watches, but potentially also vital things like medicines, especially as average tariff climb.
Then the supply chains.
They're forced into a fundamental rethink. Companies are actively adapting, shifting sourcing, moving production locations, sometimes even reshoring back home. But all that takes time and costs money, which can also feed into prices.
Makes a lot of sense. The domino effect is real. Okay, finally, third question. Companies like Lemonade and Xometry are seeing huge stock jumps despite economic uncertainty and tariffs. What are the key indicators investors should watch to identify resilient companies in this volatile environment?
Good question. For investors looking for resilience, you really need to look past the macro headlines and dig into specific company fundamentals. Key indicators. Consistent revenue growth that doesn't just grow, but beats analyst estimates like Lemonade's 34.5% growth or Xometry topping forecasts.
Beating expectations is key.
Crucial. Also, strong profitability metrics.
Right.
Think Lemonade's 109% gross profit jump and better margins. Positive guidance for future quarters is another strong signal, shows management's confidence.
So it's numbers, but also outlook.
And also the why. Look for companies in sectors with strong underlying demand, AI spending driving tech, for instance. Or companies with inherently agile business models, like Xometry's on-demand manufacturing. Or those leading fundamental shifts, like Lemonade's digital-first insurance approach. Those factors suggest an ability to adapt and maybe even thrive amid the turbulence. So we've covered a lot today. From surprisingly strong company earnings
Some real standouts there.
to the incredibly complex, constantly evolving landscape of global trade and tariffs. The interplay between that company-specific resilience and these broader shifting trade policies is really shaping our economic future in some profound ways.
Absolutely. And now, the part where we distill all that knowledge into actionable takeaways. First, monitor tariff impact beyond the headlines. Yes, big companies like Cat and Mazda are feeling it, but remember, smaller businesses and ultimately you, the consumer, will also bear costs. Higher prices on imports are likely, so watch for companies adapting, shifting supply chains, boosting domestic production. They might be better positioned.
Good point. Adaptability is key.
Second, focus on company-specific resilience. Despite the macro headwinds, companies like Lemonade and Xometry prove strong fundamentals matter. Robust revenue growth, better margins, beating estimates, these can still drive performance. It really pays to dig into individual company reports, not just make broad market assumptions.
Look under the hood, basically.
Exactly. And finally, third, stay skeptical and diversified in this environment, where economic data itself is being questioned and trade policies change on a dime. Relying on one source or narrative is just too risky. Diversify your information sources and definitely think about a diversified investment portfolio to maybe cushion against some of this policy-driven volatility.
Sound advice across the board.
Here, so don't just stay informed, stay deeply informed. Follow the deep dive wherever you get your podcasts so you never miss a beat on the global economy. You know, it seems like these tariffs are making more noise than the supply chain trying to reroute itself through a needle's eye. But unlike that tangled mess, we'll keep things perfectly clear for you.